Welcome back to Investing Talk Podcast.
Today we're looking at Chaince Digital Holdings, ticker CD.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a lot of people, Chaince Digital Holdings is probably a new name, but it really represents a pretty significant corporate transformation.
Right.
This company was formerly known as Mercurity FinTech. The rebrand was approved back in September of this year, and it all became official on November 13th.
And this is way more than just a marketing makeover. We're talking a fundamental shift in what the business actually does.
Exactly. It's a complete pivot.
So that's really the core of the story we're unpacking for you today. When a company totally changes its name like this, it's a huge signal about where their capital and, their focus is going. What is this new focus?
They are moving aggressively into some of the market's hottest areas. The new strategy is squarely on AI-powered manufacturing, sophisticated financial infrastructure, and maybe most importantly, real-world asset tokenization.
Okay, let's just pause on that for a second.
Yeah.
RWA tokenization. We hear that term everywhere now. For anyone who might be a little newer to this, what are we really talking about?
It's, simply put, the process of taking tangible assets, think real estate, art, private company shares, and putting them on a blockchain.
So they can be traded more easily.
Precisely. It makes them more liquid, more accessible. And Chaince Digital is positioning itself to build the actual infrastructure that lets the big institutional players do this at a massive scale.
And to really broadcast that ambition, they went out and made a huge hire.
They did. This might be the single most important event for them in the last 6 months. They brought on Wilfred Day, who is the former CEO of Securitized Capital, to be their chief strategy officer.
That's a big deal.
It's a huge get. It instantly gives them, deep Wall Street credibility, specifically in the tokenization space. When you make a hire like that, you're telling the market you are serious about this.
And that kind of leadership change gets you noticed. We already saw it with their index inclusion, right?
Absolutely. Even before the name change was official, they got included in the Russell Microcap Index back in September.
Which is so critical for a company this size.
It is. It forces all those passive index funds and ETFs to buy the stock. It just immediately puts you on the map for institutional investors. And on top of that, they're well-funded. Just last month, they closed a successful $8 million financing round.
And that money is going directly into the new vision.
Yep. Explicitly earmarked to accelerate their AI innovations. It's just more proof that investors are buying into this new story.
It sounds like they're really controlling the narrative.
Yeah.
We also saw their new CSO stepping up at that big conference recently.
Correct. Day was a featured speaker at the Chinese Finance Association's big annual conference. He was laying out their vision for institutional RWA tokenization, highlighting how you need to integrate AI and blockchain to make it all work.
So they're not just building the tech, they're shaping the conversation around it.
Exactly. They're putting themselves at the center of that convergence between old-school finance, AI, and on-chain innovation.
So if the new plan is AI and tokenization, let's talk about what they're building on top of. You can't just, make a pivot like this out of thin air. What was their original business, and why is it such an advantage now?
This is where it gets really interesting because their foundation is an incredible asset. The firm operates as a major, and I mean major, Asia-Pacific data center and digital infrastructure player.
Through their brand, Chindata.
Right. Chindata is seen as a regional leader in what they call hyperscale deployments. That's the kind of massive computing power that big tech and, of course, AI companies are desperate for.
So they already own the digital real estate in one of the world's fastest growing markets. But what makes their infrastructure special? Is it just the size?
The scale is one part of it. We're talking 35 centers, a staggering 945 megawatts of capacity. But their real competitive moat, their advantage, is in the efficiency. It's all about their sustainability.
Okay.
They use this next-gen tech that gives them a power usage effectiveness, or PUE, rating of 1.21.
And for listeners who don't track data center stats, put that 1.21 number in context for us. Why is that so good?
Well, think of it this way. A typical data center might have a PUE of around 1.8. That means for every watt of power going to the actual computers, almost another watt is wasted on just cooling and lights.
Wow.
A rating of 1.21 is near perfect efficiency. It means their operating costs are way lower than competitors, and it makes them the perfect partner for AI companies that use immense amounts of power. It's a green advantage you can sell.
Okay, so we have this amazing, efficient infrastructure business, a structural winner. But now we have to get to the financial reality check. Because if the core business is so strong, why the massive pivot? And what does the balance sheet actually look like today?
And that is the central conflict in this whole story. You have to look at Chains Digital as an early-stage growth company that happens to be wrapped around this really solid infrastructure business.
They're not a mature operator yet.
Not at all. Revenue growth has been pretty minimal. And the valuation, well, the valuation reflects the market is playing a very high-stakes game here.
Let's get right to it. The enterprise value to revenue multiple is sitting at something like 593 times. I mean, that is a truly eye-popping number. What on earth is the market pricing in there?
It's pricing in perfection. It means investors believe the new strategy is going to work and work spectacularly for years to come.
They're not paying for the data centers.
Not for the current revenue, no.
Yep.
They're paying for the high-margin software and financial services revenue they hope this whole AI and tokenization pivot is going to generate down the line.
So the current revenue is almost like a rounding error in the valuation. The market is betting 100% on the transformation.
Precisely. And we can see they're in a heavy investment phase. They aren't profitable. Their EV to EBITDA is negative, which means they're burning cash to grow.
Which makes them reliant on that outside funding.
Right, like that $8 million round. That always brings the risk of dilution for current shareholders if things take longer than expected.
And what about their tangible assets, all that hardware and real estate? How's the market valuing that?
Well, the price-to-book ratio is also very high, around 19.4x.
So investors are paying almost 20 times what the physical assets are worth on paper.
Because they don't see it as just land and fiber. They see it as the perfect launch pad for the next generation of digital finance. That ratio is all about the bet on that strategic optionality.
Okay, so that's the setup. An amazing structural story, but financials that reflect a high-risk startup. What is the technical momentum in the stock looking like right now?
You know, technically the setup is actually quite bullish, which is important given the fundamental picture we just painted. Over the last 3 months, the stock has shown a clear upward bias. It's trading above both its 50-day and its 200-day moving averages.
So both the short-term and long-term trends are positive.
That's right. They're both pointing up.
What about key levels people should be watching? Where's the support and where's the ceiling?
We're seeing some really solid support holding up around the $8 mark. That seems to be the floor for now. And on the upside, the key resistance is that $10.50 to $11 range.
So a clean break above $11 could be a major signal.
It could be, especially if it happens on high volume. And momentum-wise, the RSI is in a good spot. It's in that 60 to 70 range, so bullish, but not yet overbought or overheated.
And looking ahead, we have a whole series of potential catalysts lined up over the next 3 months that could really drive the price.
A packed pipeline, really. 4 big ones. First up, in late November, you have the Russell Index rebalancing.
Where funds have to adjust for the new ticker?
Exactly, it forces buying. Then, mid-December, we should see the institutional 13F filings come out.
Ah, so we get to see which big funds jumped in after the rebrand.
We do. And if a few big, respected names show up as buyers, that can create a lot of positive momentum on its own.
And then we get to the fundamentals. The numbers have to show up eventually.
Which brings us to catalyst number 3. Q3 earnings are expected around January 10th. That'll be the first real snapshot of how the new strategy is translating into operational results.
But the real main event, the one that huge valuation is betting on, has to be the product launch in January.
Absolutely. The fourth and biggest catalyst is the anticipated launch of their new AI-powered tokenization solution, expected late January. That's the moment of truth. That product validates the entire pivot.
That January timeframe is looking absolutely critical. Now, outside of those confirmed events, are there any rumors or, market chatter that could add more fuel to the fire?
Oh yeah, there's definitely some speculation out there. One of the biggest rumors is that the company is in active talks with major U.S. institutions for tokenization pilots.
Landing a big U.S. bank would be a massive stamp of approval.
It would be huge. Total validation. There's also talk about geographical expansion, looking at other APAC financial hubs like Singapore or Hong Kong. And finally, a lot of industry expectation about them launching a proprietary AI-powered digital asset registry, specifically for private market securities.
So lots of potential upside from headlines alone.
A lot. But before we get to the final thesis, we have to be crystal clear on the risks. This is an execution story.
Can they actually pull it off?
That's the primary risk. This pivot is incredibly difficult. And as we said, they're burning cash, so they depend on capital markets, which carries risk. And of course, their heavy focus on Asia-Pacific means they are exposed to geopolitical and regulatory risks you can't ignore.
Let me just challenge that for a second. Isn't the biggest risk that this is all just a story? A data center company trying to ride the coattails of buzzwords like AI and tokenization?
That's a very fair question. And what I think makes this different is that infrastructure moat we talked about. They aren't a pure software startup with just an idea. They have these tangible, highly efficient, cash flow generating data centers.
Which gives them a foundation.
It gives them a buffer and a direct sales channel to the very AI companies they want as clients. They're leveraging a real existing strength to build a new business that's very different from a pure startup. So the final thesis, weighing all of that, remains strongly bullish. I'd rate it an 8.5 out of 10.
And what's that based on?
Three things. One, the powerful long-term tailwinds in data center demand and green infrastructure. Two, the significant short-term upside from the rebrand, the bullish chart, and that catalyst pipeline we just walked through. And three, the long-term potential of being at the center of AI, blockchain, and institutional finance.
So it's an interesting one because it seems to appeal to both short-term traders playing the catalysts and the long-term investors betting on the whole structural growth story.
Absolutely. It's what you'd call an asymmetric bet. You get the stability of this world-class infrastructure business with the explosive upside potential of a fast-growing fintech company.
The true test will be whether their early proprietary lead in energy-efficient data infrastructure can successfully underwrite their massive ambition to become a digital asset and AI leader in the institutional space. That convergence and the speed at which they realize it is what investors will be watching closely over the next 3 quarters.